Hi, I'm Bob Wagner, Chief Investment Officer here at SRP, and thank you for joining the SRP Market Insights Q1 2026. Headwinds and tailwinds. Every quarter we go through the headwinds and tailwinds. Not a lot of change. We've got ongoing political uncertainty, overextension of the Magnificent Seven, and we have a rising federal debt, political uncertainty, tariffs and possible labor supply disruptions, stretched consumer spending, continued need for prudent fiscal discipline. But the one that we did add here is the tariff rulings and related uncertainty. The Supreme Court's going to be ruling on that probably sometime in the near future. It's going to be interesting to see how does the market handle that. There's basically three theories. One, the market hasn't liked the tariffs, so repealing the tariffs could be beneficial. But then you have to ask yourself what happens if the tax revenues have to be returned. The other one is that they leave things in place, and the market really didn't mind them to begin with. The market was making an all-time high with them, and it just simply business as usual keeps going higher. The third one, however, is the one that I think is the wild card. What happens if they repeal the tariffs, throw that into uncertainty, and then also have them repeal the taxes? I would imagine that would shock the back end, and that would probably be bad for the markets. But once again, all that's uncertainty. The other thing is, at least recently, those tariffs have been relatively effective in pushing the U.S. agenda on the world stage. We're able to use tariffs to get for instance, Canadians were cozying up to Canada, 100% tariff threatened there. That's not happening. So they have been able to use the tariffs effectively to push some agendas that probably are beneficial to America. So I think the Supreme Court, they're probably going to struggle with this decision. Tailwinds, fixed income is offering attractive yields. That's been ongoing. Rates are coming down, but the back end remains stubbornly high. This is the big one. Anticipated historic tax refunds, increased take-home pay as people reset their withholding, and potential tariff dividends. There's also the Invest America or Trump accounts that are going to be created this year. That's going to be bringing money into the stock market, and probably setting a nice dynamic going forward as America saves more and more going forward. Elevated levels of cash remain on the sideline. Potential for supply side economic policies and greater fiscal restraint. We're about to see the benefits of the regulatory cuts, the tax cuts, the onshoring, nearshoring, onshoring, friendshoring. So we're probably going to be seeing a lot of that coming to fruition this year. Expensing of factories, things like that. DOGE, tariffs, taxes, regulatory relief, and onshoring initiative. Those are all stimulative. We have some, the GDP is expected to be growing at over 4%. This quarter we had strong economic growth. Looking forward, we expect strong economic growth. That helps create jobs, keeps unemployment low, but it also brings in a lot of tax revenues to the government. Oil's likely to decline. Oil has been declining and is likely going to continue. What happens in Venezuela is going to drive that even lower. And then we have the diminished perception of China's economic and military invincibility and a reduced probability of hostilities. You kind of see what happened in Venezuela. The Chinese were down there, the Russians were down there, the Iranians were down there, and the U.S. was able to overwhelm all their systems and execute that operation. The key there, though, is if I was China, I'd be sitting there thinking, I might not want to invade in Taiwan right now. But we'll see. All right. Well, what we're going to do is we're going to give both a bullish and a bearish outlook for the economy, equities, and bonds. And we're going to break it down into who benefits: Wall Street, Main Street, tariffs. So if you take a look, Wall Street, there's a lot for Wall Street to celebrate. It's no coincidence that the stock market's making an all-time high right now. Deregulation is helping lower costs for corporations. And it's going to lower prices for inputs such as oil. Very good. Just go back and study the 1980s. These policies are very stimulative to the economy and the stock markets. Full expensing of major capital investments. That means, you can literally expense a factory. So if you're going to build a factory, you want to build it now in the U.S. because the tax situation is so favorable. Interest rate trends are trending lower. That's a major cost for many corporations. Once again, that helps Wall Street, investors in bonds, investors in equities. And then we have accelerated earnings and declining forward P ratios. Once again, very, very good for Wall Street. But that's not the only one. This is a very broad-based economic policy that we have coming out of Washington. Main Street's going to benefit. No tax on tips, Social Security, overtime, interest on car loans, and other wage components. So, we're going to be putting a lot of money. This is supposed to be a historic tax refund year. Elevated wage growth amid a tight labor market. As people become more productive, the wages are going higher. And then we have an aggressive anti-fraud posture and new executive orders, addressing some of the fraud that's coming out there. Taxpayers want their money managed properly. And from the scale of what I've been seeing, these the cuts and the reduction in fraud, waste, and abuse could be substantial. If that's the case, and it makes a sizable dent in the federal deficit, that could help bring the back end down. The back end of the yield curve is pretty much key to where we're going to be heading. And then, of course, we have tariffs. We have falling net exports contribute to higher GDP growth. GDP growth has been phenomenal recently, and looking forward, it looks like it's just going to continue. Solid GDP growth does a lot. Solves your unemployment issue. It brings in a lot of revenues to tax growth. The deficit becomes more manageable. You kind of grow your way out of the deficit, is what they always say. So, if we have solid economic growth this year, a lot of those problems get solved. And remembering, falling net exports boosts GDP. And then, of course, we have accelerating deglobalization. Now, that's going to be one of the big drivers for economic growth this year. As we deglobalize, we need to basically bring the manufacturing base that we've exported to other countries. We need to bring that back home. Building factories takes a lot of workers, requires a lot of purchases of materials for building. So, there's a lot of stimulus in this agenda, and a lot of it's going to be coming to fruition this year. All right, one more bullish outlook for the U.S. economy, equity, and bonds is that we're cutting taxes. So the One Big Beautiful Bill Act is cutting taxes, and it's going to have a significant impact on GDP. As you can see here, net business taxes contribute to a higher GDP. Net personal income tax cuts contribute to higher GDP. The spending cuts and the spending increases are relatively close to being the same. Spending increases has a greater magnifier than the spending cuts do. But also the spending spending cuts and spending cuts and increases aren't necessarily created equal. If you're out there cutting areas that are unproductive and spending areas in areas that are highly productive, those multipliers may change. Either way, as you can see, the tax cuts itself is expected to add 0.8% to the GDP, which is already expected to be very strong. Okay. Going on, you can just kind of see what impacts do tax cuts have. Well, sure enough, as you cut taxes, the markets tend to not only do well after the tax cuts, but also the year after that as well. So that's one factor that's going to likely impact the market. Tax cuts tend to help the markets. All right, one more bullish outlook: the U.S. economy, equity, and bonds. This is one of those situations where the stars are kind of aligning. We have the supply side policies coming in, the deregulation, things like that. That's tend to be very bullish. Then we've got the tax cuts, which are part of supply side economics, which we just covered as bullish. But then we have the Federal Reserve cutting interest rates. Even when they cut interest rates at an all-time high, the stock market still tends to go higher. So we're in a situation where there's a lot of factors working to drive the market higher. Basically, the way I describe it is like all the oars are in the water and we're all rowing in the same direction. A lot of times the fiscal policy and the regulatory policy will be going one way, but the monetary policy is going this direction. This time we have them all rowing in the same way. And so here's an example. When you cut interest rates when the markets are at all-time high, in 13 out of 13 instances, the S&P 500 delivered a positive return over the next 12 months. The average return was 19.7%. The median was 18.7%. So once again, that's a forward return strong when Fed cuts rates near all-time highs. So that's a pretty impressive statistic there. All right, well, no analysis will be complete without a bearish outlook. We just covered the bullish outlook. Now let's take a look at what's bearish. Once again, we're going to take a look at the Wall Street, Main Street, and the tariffs. We have market equity valuations are elevated. We do have persistently high fiscal deficits, and the back end has been stubborn. The turnover at the Fed often precedes volatilities. The classic example there is 87 in Greenspan. We have strong, we made a strong case for a strong economy, but that doesn't mean you're going to have a strong stock market. The two don't necessarily always go together. Then we have government intervention. We've impacting stock buybacks, interest rate dynamics, things like that. So there's things that could kind of like spook the market. You never know when those pop up. And then we have a global liquidity is shrinking. Central banks and other organizations are diversifying away from the U.S. dollar, and that's been creating some issues. Then we got Main Street. What's going on with Main Street? Well, we have stubborn inflation and elevated unemployment. It's not high unemployment, but it is relatively elevated. We got increasingly common AI-driven no hire, no fire corporate policies. Right now, the corporations are just sitting back and waiting, seeing how does this AI impact what we're doing? How many workers can we replace with it? Things like that. Then we have persistently high mortgage rates, and we have an ongoing affordability challenges and the emergence of, emergence in the existence of a K-shaped economy. Now, what is that? Well, the K-shape means that the upper income levels are doing fine, the lower income levels are not. So you get kind of this economy where some are doing well, some are doing poorly. Then we have the tariffs. We have this. We got this. The SCOTUS or the Supreme Court ruling coming up. That could be very, very concerning. Once again, there's three outcomes that we're kind of watching. One, the market, they repeal the tariffs, and the markets will like it because they didn't like them to begin with. So you can create a situation where repealing the tariffs and not requiring the refund of the tariff revenues could be beneficial. Then you could say, let's say the Supreme Court just says, we're not going to touch this one. This is up to Congress. The rules aren't written in a way that we can effectively interpret them. So we're just saying we're going to let things alone and say, Congress, you've got to settle this, not us. Markets may like that. And then there's a third situation, which I think is the wild card. What happens if they overturn the tariffs and force them to return the tax revenues? I would imagine that would be the one outcome that they're not going to like. The tariffs have had a negative impact for the U.S. on the dollar and inflation. Just recently there was comments made about the dollar that's driving it even lower. Once again, a weaker dollar isn't necessarily negative overall, because a weaker dollar means basically you're putting U.S. goods on sale to the rest of the world. But it can disrupt the markets. China increasingly likely to offload excess goods into the global markets. China's geared up for production. We used to buy a lot of their goods. As we buy less of those goods, they're not going to just stop producing. They're going to produce them, but they're going to dump them elsewhere, and that can create turmoil around the world. And then tariffs contribute to elevated yield on the long end of the yield curve. These tariff policies, the central banks diversifying away from the dollar has been creating some serious problems out in the back end, and we're going to be looking at it in a little bit. But that's essentially the bearish outlook. All right, let's take one more look at the bearish outlook for the U.S. economy, equity, and bonds. The one thing is we've got a highly concentrated equity market, and those highly concentrated stocks have a elevated PE. So if you take a look at the PE of the top 10, you can see it's 28.1. The remaining companies have 19.2. The S&P average is 22. Now that's elevated. It's a little bit more manageable with interest rates coming down than if rates were going higher. So there's one benefit. But as you can see, the top 10 are relatively highly valued. Now, if they start selling those, that's probably going to drive the market higher. But if they sell it and buy those lower value ones, that would probably damper the correction. But it's going to be interesting to see if the top 10 companies can have earnings growth high enough to justify and maintain that elevated valuation. Then if we go over to the household, as you can see, the household debt service ratio has been going higher. People, as they live off their credit cards, that creates a problem. But hopefully going forward, you'll see interest rates coming down, the economy growing, wages growing higher. That might start to turn around. But for right now, it's not going in the right direction. Same thing with the delinquencies. If you go take a look down the delinquencies have been popping up, especially for student loans. Once again, as long as rates come down, earnings growth and economic growth goes higher, that this can probably resolve itself. But for right now, that's kind of a bearish outlook. Okay, well, we just covered the bullish and bearish arguments. this is an overall theme that I think is really interesting, because I don't think if you look back in history, you can find anything like what we're experiencing now. We're having a confluence of technological advances that's pretty much unprecedented. I mean, you can go back to the late 1800s, early 1900s, where there's a lot of factors that came together. You had the railroads, you had the pipelines, you had electricity, you had the light bulb, you had the automobile, you had the plane. You had all these new telephone. You had all these new technologies coming online, and it drove extreme growth in the U.S. economy. Well, we're kind of entering a situation like that. If you look at what's happening now, we've got outer space. You're going to have cell to satellite this year. You've got a space industry and AI server farms up in outer space. You've got low cost renewable rockets. You got space travel and tourism. That's one area that's expanding. Then you got transportation. You got flying taxis and cars likely come on. You got full self-driving robot taxis and delivery. You got drone delivery. Those are all new technological advances that are going to impact the economy. You got energy. You got small modular reactors. You got small modular natural gas generators. You got new drilling technologies, batteries invention, and possibly fusion sometime in the near future. But I've been hearing that for a long time. Then you got fintech. You've got Bitcoin, blockchain, stablecoin, AI-driven fraud control, web security, all sorts of things going on there. And then you have AI and computing, and this is the biggie. You've got chip advancements. You've got quantum computing. We haven't even really seen what quantum computing can do. We've got part of it is moving electrons, which is the documents, audio, video, graphics, and then you've got partial as moving atoms, where we're going to have physical robots, and we have physical AI. We got robots, automated plants. We have AI-driven healthcare and drug advancements. We have 3D metal printing and other material printing capabilities, and then we've got AGI and beyond. So this is probably going to be an era that 50 years from now you're going to be reading about it in the textbooks like we read about the Edison era today. It's probably I would imagine in 5 years we're not going to recognize the world. Okay, here is what I think is one of the big drivers of the market right now. As you can see, this is the yield curve. You got rates over here and then maturities down here. And as you can see, this dark line is where we started last year, back on 12/31/24. As you can see, over the year, rates largely came down. This blue line is Liberation Day, where the tariffs were announced. And then here's where we are now. So as you can see, the vast majority of the yield curve came down. And the vast majority of it is below where Liberation Day was. However, this back end has remained stubbornly high. That's a problem. Rates, of course, impact mortgages, auto loans, credit cards, corporate loans, education, bank accounts, and of course your local tax rates. And so lower the interest rates helps a lot of things. But what brings the back end down is this part of the yield curve right now, and that's the mortgages. And as you know, housing takes up about 40% of the CPI. So if you get if you can get housing under control, you can have a big impact on the CPI. What I have over here is I have the interest rates for you to follow throughout the year. This is where we start. And what we hope for by the end of next year is all these rates are going to be lower, especially these back ends. Now, there's a caveat here. I'm saying the yield curve shifting down is a good thing, but the yield curve can also shift down because of a recession. So the market should go higher if the yield curve shifts down for all the right reasons. The right reasons being that we have economic growth that's not inflationary and we're paying down the federal deficit. That'll bring down the back end likely. If we fall into a recession, the back end's going to come down. Corporate bonds will lose money. Equities will lose money. That's not a good way to do it. So we don't want that. But what are the back ends of the drivers to watch? Well, federal deficit. If they start getting the federal deficit under control, they get this fraud, waste, and abuse under control, that can probably put a dent in the back end and start bringing it down. Trade deficit, unfortunately, works against the back end. That's what's kind of propping it up now. As the central banks diversify away from the dollar, they sell the U.S. bonds, and they're buying gold and other things like that. Corporations over there that need to invest here in the U.S., they'll be selling their treasury bonds. They'll be buying over, but then they'll be building a plane over here. That drives up the back end. Inflation, of course, props up the back end, and then actions by the Treasury may bring that back end down. As these rates in the front end come down, what they'll do is the Treasury will borrow the front end and buy the back end. That'll help bring down the back end. And then, of course, as this global risk premium comes down, as the world accepts that we're in a safer place, the global risk premium would basically shift this entire yield curve down lower. So that's one of the big factors to watch this year. Once again, watch this back end. If it comes down, if it comes down for all the right reasons, I would imagine that's just going to be more fuel to the fire for a bullish market driven by tax cuts and interest rates coming down as well. Okay, now I've referenced the global risk premium multiple times in this presentation. I wanted to cover why I focus on that and why that's so important. Because if you lower the global discount rate, the risk premium that's baked into the discount rates, it has a triple impact on any kind of a discounting formula, right? And so, if you take a look at like a dividend discount model or any kind of a discount model, you have value, and the value is going to be the earnings divided by the discount rate less the global earnings growth rate, right? So whatever rate this grows at gets subtracted down here. So what you want to make global value go higher, you want to have the global earnings going higher, lower risk premium makes it easier for corporations to do business around the world. So a lot of their costs that have been chewed up by the risk premium, not being able to do business here, wars, governments seizing their assets. As that goes away, their earnings go higher, right? They can suddenly find more efficient places to do business. They can find new supply chains. You don't have to worry about Venezuela taking all your oil resources, right? So earnings go higher. That's positive for valuations. Risk premium part is the discount rate. In a bond, you have the default risk, you have the risk-free rate, and then you have other risk premiums in there. Well, remove the global risk premium of that bond disappearing, the global discount rate goes lower. If you're in a safer world, you're not taking on as much risk. So the global discount rate goes down. Bring down the denominator, what happens? Value goes higher, right? Then over here, we already covered that, the global earnings increase. Well, they're going to increase at an increasing rate. Since this is negative, you want this to go higher. So as this goes higher, once again, the denominator goes lower, so the valuation goes higher. So you get a triple whammy in valuations. You got global earnings going higher by a falling risk premium. You have the global discount rate going lower because of the falling risk premium. You got global earnings growth rate increasing because of the falling global risk premium. And what does that do? All three of those work to increase the global value. So that's another thing that I'm really bullish about. And as you look forward, there's a whole bunch of factors that could fall into play that could really make the globe just like the fall of the Berlin Wall, except that we're in a new era. I call it the Pax Americana era. The American peace. If things continue to go the direction that they're headed, there's a possibility that Venezuela is going to be a very productive member in the Western Hemisphere. Cuba no longer is getting support from Venezuela. Mexico is starting to pull back their support. So that communist era may turn over. What's going on in Iran may turn over that leadership in Iran as well. The Russian-Ukrainian war will likely come to an end if oil prices keep going lower. So there's a lot of things on the horizon that could lead to a much safer world. And so it's going to be interesting to see. But this is the mechanism by which you can make a very solid bullish case that the equity markets are likely to go higher if the global risk premium continues to go south, just like it did in the fall of the Berlin Wall, the ending of World War II, the ending of World War I. We had the roaring 20s after World War I. We had the 50s through the 70s rallies after World War II. We had the rally after the fall of the Berlin Wall. And so making a safer world to do business in is typically very good for valuations.